The Indian foreign exchange market witnessed heightened activity on Monday as the dollar-rupee one-day swap rate surged sharply, driven by strong quarter-end demand for U.S. dollars from domestic banks and corporate entities. Despite the turbulence in the derivatives segment, the spot rupee remained largely flat against the U.S. dollar, reflecting stable overall demand-supply conditions in the immediate cash market. Quarter-end dynamics at play. Market analysts highlighted that the last trading sessions of a quarter typically see elevated demand for U.S. dollars as importers, multinational companies, and banks rush to settle overseas payments, book profits, and adjust balance sheets. This time, those dynamics were amplified by stronger than usual outflows, pushing the one-day dollar-rupee swap rate significantly higher. Dealers noted that while the swap market saw sudden spikes in premiums, the spot market stability indicated that broader fundamentals, including steady foreign fund inflows into equities and bonds, helped anchor the rupee's exchange rate. Spot rupee holds firm. In the spot market, the rupee closed almost unchanged near 83.44 per dollar, supported by consistent intervention from the Reserve Bank of India (RBI) and positive domestic equity market momentum. The RBI has been actively managing liquidity and exchange rate volatility, ensuring that quarter-end distortions in swaps do not spill over into the spot market. Traders also pointed out that India's strong foreign exchange reserves, currently above $650 billion, provide a robust buffer, helping the rupee withstand pressure from sudden dollar demand spikes. Impact on forward and derivative markets. While the spot market showed little movement, the forward and derivatives markets witnessed wide fluctuations. The surge in swap premiums implied that short-term dollar borrowing costs spiked, increasing hedging expenses for importers and traders. Exporters, however, saw an opportunity to lock in more favorable forward rates. Analysts said that the distortion would likely ease once quarter-end flows subside, bringing swap rates back to more normal levels. Yet, the episode underlines how liquidity mismatches at the end of accounting periods can create sharp, short-lived movements in currency derivatives. Global backdrop. The rupee's resilience also comes at a time when the U.S. dollar index remains firm, supported by robust U.S. economic data and cautious risk sentiment globally. While most Asian currencies have weakened in recent weeks, the rupee has traded in a tight range, reflecting both RBI's interventions and India's improving macroeconomic position. Looking ahead, currency strategists expect the rupee to remain range-bound between 83.30 and 83.60 per dollar in the near term, with flows around the upcoming corporate tax deadline and global oil price movements being key factors. A further surge in crude oil prices could weigh on the rupee by widening India's trade deficit, while strong foreign portfolio inflows would provide upside support. In the swaps market, traders anticipate that the quarter-end pressure will normalize in the coming days, bringing one-day rates back in line with historical averages. However, continued global uncertainty, particularly around U.S. interest rates and geopolitical tensions, could inject volatility into India's currency markets in October. Conclusion. The surge in the dollar-rupee one-day swap rate highlights the unique pressures of quarter-end financial flows, even as the spot market remained calm and resilient. With strong reserves, steady capital inflows, and active RBI management, the rupee has so far avoided large-scale volatility. Nevertheless, short-term dislocations in swap markets remind participants that currency stability is often a delicate balance between domestic liquidity cycles and global forces.